Welcome back to The Informed Edge, the podcast where we turn market noise into actionable intelligence. I'm your host, Alex, and today we're tackling one of the most frustrating yet critical aspects of trading, those sudden, violent market reversals that seem to come out of nowhere, wipe out your profits, and hit your stop loss. Joining me to demystify this phenomenon is an expert who lives and breathes macroeconomics, market strategist Dr. Ben Carter. Ben, thanks for being here.
Alex, it's a pleasure. It's an incredibly important topic. And honestly, it's the difference between treating trading like a casino and treating it like a strategic, disciplined business.
Strategic, disciplined business. I love that. Let's start with the context. Everyone who's traded for more than a week has experienced it. Your Euro-USD trade is sailing smoothly, you're mentally calculating your gains, and then boom, a massive candle wipes you out in seconds. We often blame luck or market manipulation. What is actually happening in those moments?
It's so easy to personalize that loss, right? To think the market is out to get you. But the reality is far simpler and more powerful. It's the real economy making itself known. That abrupt movement wasn't magic. It was a single crucial piece of economic data being released, and the algorithms, the big funds, the institutional money reacted at lightning speed. Trading at its purest is about managing uncertainty, but uncertainty isn't a vacuum. It's actually filled with a calendar of predictable, known events.
So the economic calendar isn't just a nice-to-have tool, it's essentially the market's GPS.
Exactly. It's your definitive roadmap. It tells you where the tight curves are coming, the high volatility zones, and where the risk is concentrated. Ignoring it, as the old saying goes, is like trying to drive a Formula One car blindfolded. It's fast, risky, and guaranteed to end badly. Elite traders, the professionals who are consistent, they don't look for opportunities. They anticipate them by living and breathing that calendar.
That makes sense. It's about anticipation. Let's dive into the core discussion. How do we, as retail traders, start thinking like the pros? The economic calendar is often overwhelming, hundreds of events a week. How do we filter the noise?
That's the crucial first step, classifying impact. You need to internalize the volatility tsunami warning system. Most calendars use a color code or an icon system. We often see 1, 2, or 3 bulls, or sometimes just gray, yellow, and red.
So break down those impact categories for us. What should we truly worry about?
The low-impact ones, usually the gray or green events, you can generally ignore them. They're routine reports, minor sectors. The market absorbs them without major fuss. The medium impact, yellow or orange, these confirm existing trends. They might move less liquid pairs or specific commodities, so they require a degree of attention, especially if you're positioned in those assets. But the high impact, the red, the 3 bull events, that's where the action is. These are the big announcements, monetary policy decisions, inflation reports like the CPI, interest rate changes, and major employment data. They generate what I call the tsunami effect.
The tsunami effect, that sounds dramatic. Why do these specific reports cause such a disproportionate reaction?
It comes down to the surprise. The market is incredibly efficient. Before any high-impact data is released, analysts and economists form a consensus, what they expect the number to be. The market has already factored that expectation into the current price. It's priced in. The volatility only explodes when the actual result contradicts that consensus.
Can you give us a practical analogy to make that clearer?
Sure. Think of the Consumer Price Index, or CPI. That's the gauge of inflation. Let's say the analyst's consensus expected the reading to be 2.5%, suggesting steady inflation. Suddenly, the actual result comes out at 4.5%. That's a huge positive discrepancy. It means the economy is overheating far faster than anticipated.
And what's the instantaneous, almost instinctive market reaction to that overheating.
The central bank, the Fed, the ECB, is like the doctor. If the economy is running a high fever, the doctor has to administer strong medicine. That medicine is raising interest rates. Higher interest rates make a currency more attractive to foreign investors because they get a better return. So you see a sharp and immediate strengthening of that currency, causing a rally or a slump in minutes. The traders who anticipated that reaction, not just the number itself, are the ones capturing exponential profits. It's trading the surprise, not the data.
That's a brilliant insight. It's not good versus bad data, it's actual versus expected data. Now, to trade this effectively, we need to talk about the tools. Which economic calendars are the gold standard for trustworthiness?
Trustworthiness is indeed a pillar of responsible trading. There are 3 platforms professionals rely on. First, Forex Factory Calendar. For currency traders, it's the gold standard. Its design is old school, but its functionality is unmatched. Its folder system, yellow, orange, red, is the industry standard for impact. Crucially, it gives you the previous data, the forecast, consensus, and the actual result side by side.
So Forex Factory is best for speed and precision on Forex. What about a trader who touches stocks or commodities as well?
That's where investing.com's economic calendar shines. It's the multifunctional all-rounder. Modern design, very beginner-friendly, and it covers a vast range of countries and assets, currencies, stocks, metals. The downside is the sheer volume of information can be overwhelming, so you must be rigorous with their filters.
And finally, you have trading economics. This is for the macroeconomics aficionados, the pure data specialists. It's fantastic for understanding the underlying context, the time series, the historical trend. I often advise a hybrid approach. Use Forex Factory for the high volatility event speed and trading economics to understand the long-term context. And a vital, non-negotiable tip, always configure the platform's time zone to match your local time. A time zone error will absolutely cost you money.
That's a great coach's tip right there. Let's shift our focus to the global vitals, the events that truly move the needle. We hear acronyms constantly: NFP, CPI, FOMC. Why are these the big 3? Think of the economy as the human body. It has minor signs, but it also has vital signs, the ones that indicate life or death. These are the global vital signs. First, non-farm payroll, or NFP. This is the U.S. employment report. It released the first Friday of every month. It's globally anticipated because a strong labor market means strong consumer spending, and that gives the Fed, the green light to consider raising rates. Conversely, a weak NFP forces them to be dovish or softer, which weakens the dollar. It's a massive directional signal.
And the second vital sign, the one everyone feels at the grocery store?
That's the Consumer Price Index, the measure of inflation, the silent enemy of purchasing power. We used the garden hose metaphor earlier. If the inflation stream is too strong, the central bank has to step on the hose, raise rates, to control the flow. The Fed and the European Central Bank have a dual mandate: price stability and full employment. The CPI is their primary tool for managing that price stability mission.
And the most authoritative, highest impact event of all,
The central bank interest rate decisions. This is the heavyweight champion. We're talking about the meetings of the Federal Open Market Committee, the FOMC, the ECB Governing Council, the Bank of England, the BOE. An interest rate decision directly impacts the attractiveness of the currency. If a country raises rates, capital moves there for a higher return.
Here's a practical reflection for our listeners. What's the most important part of the FOMC meeting, for example? Is it just the number they announce?
It's not just the rate number. That's often already highly predicted. What truly moves markets over the long term is the statement that accompanies it, the subsequent press conference, and the forward guidance. That's the signal they give about future rate hikes or cuts. The market is constantly pricing in the future, and the forward guidance is the map to that future.
That brings us perfectly to the psychology of this. These high-impact events are chaotic. They trigger fear, greed, and impulsive actions. What's the emotional or psychological insight we need to master discrepancy?
The emotional insight is patience. The novice trader sees the high-impact number come out and immediately buys or sells based on the initial spike. That initial spike, however, is often just noise. It's algorithmic stop running, shaking out all the poorly placed stops. The professional waits. They wait for the first 5 to 10 minutes for the initial volatility to settle down and see if the initial direction is confirmed or if a reversal is taken.